Imagine two people with the same paycheck, same job, same salary, same city. 10 years go by. One of them still feels like they have just enough. Bills are paid, but that's about it. The other? Their money is quietly making more money while they sleep. They didn't work more hours. They didn't win the lottery. They just chose different homes for their cash. So what did that second person quietly do differently? They stopped treating money like a paycheck and started treating it like a toolbox. Instead of letting every dollar sprint in and out of their checking account, they trained some of those dollars to become workers that go out, earn, and report back. That, in plain language, is what investing really is. Investing is the craft of assigning roles to your money. Some of your dollars take on adventurous projects, others guard stability, and a few stand by for surprises. Think of it like organizing a team for a long journey. You've got scouts, builders, and protectors. Each has a different job, a different pace, and a different level of risk. In this episode, we're going to unpack those roles. We'll look at the main jobs your money can do in the financial world and how combining them thoughtfully can shift you from constantly chasing income to slowly building a system that supports you. Now, instead of imagining one giant switch labeled Invest, I want you to picture a panel of dials you can adjust over time. Each type of investment has its own rhythm, like instruments in a band. Some are steady like a drum beat, others are loud and unpredictable, more like a guitar solo. Your job is not to guess the next hit song. Your job is to learn what each instrument sounds like, how it behaves when markets get noisy, and how they can play together. Before you pick anything, it really helps to understand the main categories on the menu and what role each one tends to play. So let's lay out that menu. Think of the investing menu in three big groups: growth engines, stabilizers, and wildcards. First up, growth engines. Growth engines are the parts of your portfolio you expect to pull most of the weight over many years. This is where stocks live. When you buy a stock, you're essentially saying, I believe this business will solve problems, serve customers, and become more valuable over time. And I want a slice of that. Some companies are like sprinters, fast-growing and unpredictable. Others are like marathoners, slower, steadier, and built for the long haul. Either way, these are your long-distance runners. They're not your emergency cash. They're the dollars you send out to grow over time, knowing the path might be bumpy. Next, let's talk about stabilizers. Stabilizers are the investments whose main job is to smooth out the ride. This is where bonds usually sit. Picture bonds as the shock absorbers in a car. They don't make the engine faster, but they do keep your teeth from rattling when the road gets rough. With bonds, you're lending your money out. In exchange, you typically get agreed-upon interest payments and a date when you're supposed to be paid back. Bonds can still wobble in value. They're not perfectly calm, but compared with stocks, their mood swings are usually milder. So, stocks are your growth engines, bonds are your stabilizers. Now let's get to the third group, wildcards. Wildcards are everything that doesn't fit neatly into those first two buckets: real estate, commodities like gold, and other alternatives. These aren't necessarily about beating stocks or bonds. They're more about adding different flavors of risk. Here's a simple way to think about it. If stocks are like owning a bakery, and bonds are like lending money to that bakery, then some alternatives are like owning the building the bakery rents, or holding the flour that every bakery needs. They're connected to the business world, but from a different angle. Wildcards can be useful because sometimes they zig when other parts of your portfolio zag. That contrast can help your overall mix feel a little less bumpy. So those are your three big groups: growth engines, stabilizers, and wildcards. Your personal blend of those three becomes your money system. An aggressive setup tilts heavily toward engines, toward growth. A conservative one leans more on stabilizers. And the right mix for you depends less on headlines and more on a few personal questions like, how long until you need this money? How well do you sleep when prices swing around? Can your paycheck cover most surprises, or does your portfolio need to help with that? Those answers matter a lot more than whatever the market did last Tuesday. And here's an important point. You're not locked into one recipe forever. As your life shifts, a new job, kids, caring for parents, nearing retirement, you can gradually retune the mix. You're nudging dials, not slamming switches. Let's make this more concrete with a simple story. Imagine you're planning a long trip with two friends. Your high-energy friend books every day with mountain hikes and early morning adventures. That's like money chasing bigger opportunities. More upside, but also more exhaustion if things don't go as planned. Your cautious friend fills the schedule with museums and cafes. That's like money favoring predictability. Fewer surprises, fewer dramatic highs and lows. Neither trip is wrong. They're just different ways to use the same limited vacation days. You're doing the same thing with your dollars. You might send some money on adventures that could reshape your future lifestyle. You might assign other money to routine shifts that mainly keep things running smoothly. And you might keep a portion on the bench, waiting for last-minute chances, like grabbing a discount flight or a hotel upgrade when plans suddenly change. Over time, you start to learn your own preferences. You figure out how much surprise you actually enjoy, how much structure keeps you calm, and which memories feel worth the trade-offs. Investing works the same way. It's less about copying someone else's itinerary and more about gradually designing one that fits how you really want your life to feel. Now, as tools and markets evolve, your money system may start to feel less like a fixed switchboard and more like a smart thermostat. It can quietly adjust as your life and the world change. New asset types show up, climate risks grow, global shocks appear out of nowhere and add surprise storms to the forecast. But even with all that, the core skill stays the same. You're learning to tune, not time. You're not trying to place a perfect bet. You're aiming for steady navigation, checking the map often enough to adjust without overreacting to every headline. Over the years, you may realize something powerful. Investing isn't a test you're supposed to ace. It's a language you get gradually fluent in. The goal is not to predict every plot twist. The goal is to keep writing the story. It's like tending a small garden on your balcony. You don't control the weather, but with consistent planting, light pruning, and some patience, you can still turn a bare railing into something quietly alive. Let that image sink in for a second. All right, let's land this with some clear, simple steps. Here's your action plan for this week. Step 1. Take a few minutes to write down the key ideas from today. Growth engines like stocks, stabilizers like bonds, and wildcards like real estate or commodities. Just getting this out of your head and onto paper makes it easier to remember and easier to act on. Step 2. Identify one specific area where this knowledge applies to your life right now. It might be your retirement account at work, some cash just sitting in a savings account, or an investment you already own but don't really understand. Step 3. Take one small action this week to apply what you learned. And I really do mean small. That could be logging into your retirement account and checking how much is in stocks versus bonds, reading the basic description of a fund you already own, or setting a calendar reminder to move a tiny amount of money, maybe 1% of your paycheck, into an investment account. If you do just those 3 steps, you've turned this episode from information into real progress. So, as we wrap up, here's what we covered today in plain language. You learned that investing is really about giving your dollars different jobs, some to grow, some to steady the ride, and some to behave differently when the world feels uncertain. You heard how stocks, as growth engines, can power long-term wealth, even though the journey can be bumpy. You saw how bonds act as stabilizers, helping to smooth out the ups and downs by trading some growth for more predictability. You discovered that wild cards, things like real estate or commodities, aren't magic, but they can add a different flavor of risk that sometimes moves in its own rhythm. And most importantly, you now know that your mix of these pieces is personal. It can change as your life changes. You don't need a perfect forecast, you just need a system you can tune over time. If you remember nothing else, remember this. Investing isn't about being the smartest person in the room. It's about being the most consistent. Start where you are, use what you have, and give a few of your dollars new jobs this week. That's how you slowly move from just enough to money that quietly works for you in the background. One small step, one simple choice at a time.